So we've basically only gone through 2 of the 8 procedures, right? So let's go through some more. I'll do it in order that I have it on my. So the first one we went over was inspection of documents and records. But I told you guys a couple weeks ago, we were going to come back to something that Jose said in class about third party. So the auditor is going to get documents and records either from the client or from somewhere else, right? When it's from the client, you'll see something indicating that it was prepared by a client. Often it might just have the initials PBC, prepared by client. That means that it was an internal record that the client provided to the auditor versus third-party evidence. So that's going to be documents prepared by independent third parties. I think Anthony mentioned bank statements. It depends on where the auditor gets them. If they get them directly from the bank, it's considered third-party outside evidence. If they get them from the client, it's considered internal or prepared by client. Why? Because it was in the client's possession, meaning that they had an opportunity to manipulate it if they could. I'm not saying that they did, but we're professionally skeptical. So typically now you can get proxies into your client's systems and proxy access to their bank statements too. So you can bypass that in most instances. So which is considered more reliable according to the PCAOB? Getting independent outside third-party evidence or getting it directly from the client? So what's more reliable? Documents prepared by that independent outside party. We got tracing, we got vouching, inspection of tangible evidence. For the most part, again, that's going to be a test that is going to give us evidence around existence. I know the book mentions mentions valuation, but just like I gave you that forklift example, the evidence that the auditor gets around valuation is limited. It has to be an extreme situation where, like I said, if there's like something that's obviously decrepit and falling apart in the corner, and you go to the client's records and see that it's fully valued there, that's a problem. But existence. And let's say I go to a copy machine on this floor. I don't think there is one, but pretend there is. A copy machine on this floor, and I look at it. Can I tell whether or not Rutgers owns that copy machine or if they lease it? No, I can't. So you don't get evidence around rights or obligations when you just inspect an object. And that's something I wanted to bring out with that one. What was the next one in the order of your book? Observation, number 3. Very good, like this one. So observation means that the auditor is literally observing someone performing a task. They're looking at them, they're watching. They're watching, they're looking. So what do you think? Is that a test of details or a substantive test? Or is that a test of controls? Tell me why it's a test of controls. Remember, controls had to do with policies and procedures that so they're actually doing some sort of activity. Well, when you're observing, you're watching them do that activity. So you're observing them perform that control activity. So it's a test of controls, a weak one, because obviously if they see you seeing them do it, they could try to perform it a little bit better than if you were not there, right? So which is why it's always best to get some sort of documentary proof other than observation, because the evidence there is a little bit weaker, but it is a test for controls. Somebody said it's a test of substantive, or it's a test of details or substantive procedure too. Why do you think that? Because in my head, I remember that for it to be a test of details, I need to be able to easily recognize which assertion and which account, right? Which financial statement account. I'm not so sure I could do that, but I'm open if somebody else thinks that they can. Why do you think it might be a test of details? So yes, observation is typically a test of controls. It's a procedure so it's one of the 4 of these out of 8 that are used to test controls. Number 5, the procedure was confirmations. What's a confirmation? Confirmations are direct correspondence between the auditor and the third party. So confirmations are considered outside third-party evidence. What is a confirmation? There are different types of confirmations. Typically, they have to do with balance sheet accounts. That's a hint. So the auditor, it literally is, well, auditors can send them by electronic means now, but I'm thinking of the accounts receivable cycle, or the revenue collection cycle. That's where the first example of a confirmation is. It's a document prepared by the auditor, approved by the client, but the auditor sends that to an independent third party to confirm a balance. So as Anthony was mentioned, you can send what's called bank or cash confirmation. And what the auditor does is they say, okay, for this particular bank, this is the amount that the client has on their books for cash as of December 31st or whatever the year end is. They send it to the bank and ask them to confirm that balance, right? Is this right? Is it not right? Let us know. And then that document is sent directly back to the auditor. Cash, accounts payables, confirmations can be sent to vendors. Accounts receivable confirmations can be sent to customers, the client's customers. So what assertion, if the auditor sent a confirmation, let's use a specific example. If the auditor sent an accounts payable confirmation to a vendor, got it back, what assertion would they be testing? If the auditor sent an accounts payable confirmation to the vendor sent it back, what assertion would the auditor be testing? Existence, right? If the auditor is saying, hey, the client says they have $1 million they owe you $1 million, and I go to the vendor and say, do they owe you $1 million? That's evidence that that balance is real, that it actually exists. Same with cash. If the auditor sees $1 million in cash on the client's balance sheet, and they go to the bank and say, is this real? They're getting evidence as to whether or not that balance exists. Now, the book does talk about some other assertions, but mainly you send confirmations to test existence. If you want to know something's real, ask an independent third party to confirm that it's real. And notice that I said that it has to do with balances. So it's not occurrence, right? But confirmations are always, in fact, here's a hint for some of the tests that you're going to have. If you're asked to come up with your own substantive procedure for a specific cycle, and then asked to give the assertion that that procedure tests, sending a confirmation is the easiest one to remember. Just insert whatever account it is. If we're asking about accounts payable, say the auditor sends an accounts payable confirmation. If we're asking about cash, say the auditor sends a cash confirmation. Easiest substantive procedure to remember, because if you're then asked, well, what assertion does that procedure that you came up with test? What's the answer always going to be? Existence. It's an easy one to remember. Send a fill in the blank confirmation. You actually have to fill in the blank though. And what assertion is it testing? Existence. Now the book does talk about some other assertions that sending confirmations could get limited evidence for, right? Rights, obligations, sometimes valuation and cutoff, very, very limited. But the main reason that the auditor sends confirmations is to test existence. All right.